Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets and what we're doing in our portfolios or looking at. As always, please don't use these for trading purposes. They are for information only. I start here with the weekly chart of the S&P 500. Goes back to just the end of 2020 here on the left side. So we're getting about a total 5 years there. As you can see, we had a nice uptrend going after the 22 bear market. And then earlier this year had a nice sell-off going as there might have been some world trade wars kind of thing, but that seems to have resolved itself a bit, at least from the market's perspective, as we're coming back here to all-time highs. I mean, we're just short of them, as you can see. So nice dip back. Some of the things I'd like to show here is, it really returned to its trend line, which had been drawn there from 23. And the market came back and tested it. It tested exactly to another level that we were looking at, which was the high here from 21. So the market seems to have a memory. It goes back and tests significant places and significant trend lines, as you can see here. But we're coming up here to all-time highs, so it seems all clear as far as the market's perspective at the moment. We'll see how that all works out. We come here to a daily chart, gives us a little more detail, and you can see here the start of 25, it was not good. We were going sideways there from Thanksgiving on to about February, but then the market broke down as the tariffs threats started to come out. Since then, we've broken into an uptrend. As you can see here, I haven't even drawn an uptrend line on it because it's really too steep at the moment. But it basically just became a bounce right back to the old-time highs, much stronger than people had thought. So from the weekly and from the daily perspective right now, we are back in uptrends. The market is looking bullish and looking surprisingly like it's going to go try to take out the all-time highs here. So all systems go so far, I guess. We come down here to a 2-hour chart. This gives us about last 6 months trading, gives us more detail. And you can see the trend channel that we've been running in as we go up. So again, all the price charts that we're looking at that tell us, okay, this is what the market's thinking, whether we think there's going to be a recession or trade problems or anything like that. We get paid to pay attention to the markets and move our portfolios accordingly. And accordingly, it wouldn't be too light in this market at the moment. It's back into a bull session. We go here to look at some of our internal. Let me go back a second. Actually, I forgot to look here. This line below is the bullish percent. It's the percentage of the S&P 500 that's in an uptrend, and as you can see right now, it's 72%, just under there, which means that 3/4 of the market or of the stocks are in uptrends, which is a good thing to see. Sometimes you'll see, like here, if we come back to February, and we were at all-time highs here in February, and the market's at 50%. So basically only half of the stocks at that moment were in uptrends, which is telling you that's a really weak new highs. We come down here, the New York advanced decline line. This is the advancers versus decliners on the New York Stock Exchange. And you can see that's been in an uptrend, little bit off through May there, but still a nice uptrend coming here through April. So nothing there to worry about. And then finally, the bottom is the VIX, the volatility index, what people are paying for protective puts on their portfolios. And it's down at about 17, coming way off of the highs. Not down at the really, really low numbers. Sometimes you'll see this in a 12 when it's just there is no sell-off in sight. But I'm not seeing anything here that's telling us that we should be concerned at the moment. If I come down here to some other ratios, we have just difference between consumer discretionary stocks sector and consumer staples. It's actually fairly positive. This is the same chart with equal weight. It's just a little bit different exchange traded fund. Then if we go technology versus utilities, where people are betting, technology is outpacing here for the last couple of months for sure over utilities. That's a bullish sign. Biotech over healthcare, same thing. And then finally, hotels over utilities. and gives us appetite for risk that people are seeing, or whether they think there's a recession. Because in a recession, utilities will still do well. People will still pay their electric bill, but they might not go book a hotel for a trip. And right now, the hotels are outpacing as well. So I'm not really seeing anything internally to be that concerned about. We come down here to treasuries, the interest rate on the 10-year U.S. Treasury. It's just staying in that same area we've been in now for 3 years straight. We're about the mid 4%. So no adjustments there. Usually the movement in treasury is what can really affect things. Like, for example, here we were at the lows post-COVID. The interest rates came way down. And then through 22, we had a bear market in stocks, as you recall, and you can see why the interest rates just started to spike, as they thought that the Fed would start raising rates to control inflation. And it did cause a bear market. So that's always concerning when interest rates start to really move. But right now, they're just steady right here, as we can see for the last few years. Come down to some of our economic indicators, GDP growth rate. Our last read had been a little negative, but nothing too terrible. So the payrolls, they're still steady, 139,000 jobs on the last reading. That's not bad. Inflation mid twos. Retail sales, sorry, that popped up there. Retail sales, if we come here, they're still positive, not fantastic, but still positive. And then if we come here to valuation on the S&P 500, again, that's really high. It's been really high. We've been saying for a while it was nice to have that pull back and have it come close to 20 times earnings here. But again, we're off to the races. And so we still have that same problem of the market being a bit overvalued. So we'll keep an eye on that, but that's not a great timing indicator. It's just something to keep in the back of your mind that the market is overvalued. But so for the time being, though, if we come back to the overall picture here, again, we have a market in a bull market, and the price and some of the internals are not telling us that there's anything to worry about here. So we'd be staying invested, even if you are cautiously so because of the overvaluation or anything like that. Or certainly there's headline risk. We see headline risk all the time about trade wars or other wars that can be concerning. But the overall market is not giving us anything right now to be too concerned about. So just invested for the time being, and just as always watching closely. So hopefully this was informative and helpful. If you have any questions that you'd like to hear in future videos, or you'd like to hear more about what we do for our clients to navigate through these things and make adjustments in portfolios as the market dictates, please don't hesitate to reach out. I will put up here our contact information. And as I said, if there's anything we can do for you, please do reach out. Otherwise, hope it was informative and helpful, and we'll see you at the next update. Thanks for watching.